Your newsfeed right now is probably a terrifying place. We're staring down aggressive new trade wars, stubborn inflation, and stock market volatility, colliding with announcements of widespread corporate layoffs. When faced with that kind of economic threat matrix, human instinct screams at you to play defense. You want to hoard your cash, halt your spending, and sell off your investments before they drop to zero. Looking back at decades of market history reveals a harsh reality. Reacting emotionally to those terrifying headlines is the absolute fastest way to permanently wipe out your long-term wealth. To survive the 2026 economy, we have to tune out the noise. We need to trace exactly how these invisible, macroeconomic policies physically travel through the global system and land squarely in your bank account. Let's start with tariffs. When Washington imposes a tariff on another country, it's easy to picture a foreign government writing a massive check to the United States. That is entirely false. A tariff is an upfront tax. When a product arrives at the border, the U.S. importer pays that tax to the government. They then face limited choices: eat the cost, find a new supplier, or raise prices. Inevitably, they raise prices, passing the extra cost directly to you. We see this clearly in the automotive industry. A single car relies on a highly complex supply chain, where parts cross borders multiple times before the vehicle is even assembled. Taxing those imported components drives up the total cost of production. The exact same logic applies to housing. Builders rely heavily on imported steel, aluminum, and lumber. When raw materials get taxed at the border, construction gets more expensive, eventually resulting in higher home prices and steeper rents. These policies are not always permanent. Governments frequently adjust tariff rates to relieve pressure on the consumer. We recently saw this happen when access to imported lean beef was expanded to help bring down extreme ground beef prices. Ultimately, what begins as a high-level political tool in Washington travels through corporations and supply chains until it shows up as an unavoidable extra fee built into your daily household budget. When household budgets stretch to their limits from those higher prices, consumer spending slows down entirely. This graph illustrates what happens when that spending stops. If the total value of all goods and services produced, the gross domestic product, shrinks for 2 consecutive quarters, economists officially declare a recession. We are seeing clear warning signs of this slowdown right now in 2026. The bond market is flashing an inverted yield curve, and the manufacturing sector has been contracting for months as businesses pull back on production. When corporations see GDP shrinking and their profits dropping, they immediately move to cut operational costs. That means freezing new hires and initiating massive layoffs. The macroeconomic data of a recession translates into real-world consequences very quickly. When corporate growth stops, your primary source of income is directly threatened. When you combine the threat of expensive trade wars with the looming shadow of a recession, fear takes over. Investors panic and start dumping their shares on Wall Street. Here is where the data diverges from human emotion. The stock market is a forward-looking mechanism. It often drops before a recession even starts, and it typically begins to recover while the economic news still looks terrible. Take a look at this chart of the S&P 500. You can clearly see the devastating drops during the 2000 dot-com bubble, the 2008 financial crisis, and the 2020 pandemic. Following every single crash, the market bonds out and executes a steep recovery, pushing to new all-time highs. Investors who sell everything in the middle of a crash permanently lock in their losses. Those who have the discipline to wait out the friction capture the entire recovery. You cannot control Washington's trade policies or Wall Street's trading algorithms, but you have complete control over your own personal financial architecture. Your first line of defense is cash. You need 3 to 6 months of living expenses parked safely in a high-yield savings account to absorb the shock of an unexpected job loss. That cash buffer is a strategic shield. Having that money readily available completely severs the need to sell off your investments for survival money when market prices are at their lowest. This animation shows your second line of defense, dollar cost averaging. If you keep your automatic monthly investments running right through a market crash, your fixed dollar amount actually buys more shares. You accumulate assets at a massive discount. And your final defense is simple diversification. Owning a broad index fund ensures that your entire net worth won't be wiped out just because a new tariff targets one specific industry. Governments will always rotate their policies, and global markets will always cycle through periods of fear and greed. A disciplined financial plan is built to withstand all of it. By understanding the actual mechanics of the economy, you stop being a victim of terrifying headlines. You step out of the panic and you become a resilient, unstoppable investor.